Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at VALIDEA Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of VALIDEA Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of VALIDEA Capital.
Hey guys, this is Justin. In this episode of XS Returns, Jack sits down with our good friend Tobias Carlisle. They cover a wide range of topics, including the recent run in small cap stocks, the future of value investing, and the outlook for the Mag 7 stocks. They also take a deep dive into Toby's portfolio construction process, from the selection of the universe all the way down to issues like portfolio size and sector concentration. Toby is a deep thinker and always brings an interesting perspective to every conversation we have with him. Thank you for listening. Please enjoy this discussion with Tobias Carlisle.
Toby, thanks for coming back on Excess Returns.
Hey Jack, my pleasure. Thank you for having me.
I was counting before we just started, and I believe this is now your 7th appearance, which ties you with Cullen Roche for the most appearances on Excess Returns. So
nice.
I can only assume that's a very coveted title in the podcast world, being the frequent guest on Excess Returns. So we'll get a little battle with the two of you going.
It's a great podcast. I'm honored.
Do you remember with Saturday Night Live, they used to do this? Remember like Steve Martin, I think, and maybe Alec Baldwin?
Yeah,
when they would host, they would always have this back and forth of like who had the most hostings or something like that. So we'll get something similar going here.
I love it.
So I wanted to start. I mean, we're going to dig deep into how you construct a value strategy as we move on here. But I want to start just with what's going on in general in the market, because it's been a really interesting market. I mean, it hasn't been like at the index level, it hasn't been that exciting of a market, but behind the scenes, it's been a really exciting market, and especially what's been going on with value recently. I mean, we've seen after that inflation print, we've finally seen the surge in value we were hoping for, and I'm hoping, we've seen a lot of false ones over the years, so I'm hoping it's not that, but how do you think about it? Like, what are you seeing right now in value?
So it seems to have had only over the last few weeks, I don't even know how, it might not even be a month. It has outperformed pretty materially, largely driven, I think, by the fact that it had underperformed this year up until very recently. And it seems to be, it's not just value, it's the market, the index is float adjusted market capitalization weighted, and it's the very biggest Mag 7, and then even among the Mag 7, it's NVIDIA, which the N used to be Netflix, I guess now it's NVIDIA. I don't know how it works anymore, but it's a narrow market, I think. Like until recently, joking or not, I think folks were saying, it's like 7 outperforming and 493 underperforming. I don't think that's quite right. I think it's about 1/3 outperforming, 2/3 underperforming. No idea whether historically that's significant or not. I think you need to go back a little bit though. Like clearly I think value probably bottomed in late 2020 and has been outperforming since. But that probably ended a little bit at the start of this year. And then largely the reasons for that outperformance, I guess, would be because it had underperformed so materially for the 10 or 15 years before that, which is a very long period of time. There's sort of two things going on, right? There's the returns to value itself, and then there's the returns to the index. And neither of them are really predictable or controllable. I think the best you can do is sort of take the opportunity set that you're presented with and try to construct a portfolio that whatever happens will do sort of sufficiently well. And so that's what I'm always trying to do. My bias is probably towards value, but I don't think it's like a naive bias. I think it's a reasonably educated bet based on the historical performance of value and size and various other things. So I think I really have no idea. I think that I probably had more idea 5 years ago. I think the longer that I do this, the less idea I have of where we are and what's happening. I think all you can do is put together a sensible portfolio and maintain that position sort of whatever happens. I think the great risk to people is that they chop and change all the time, and you get upset with the way that value's performed and throw it overboard, along with everybody else, right at the point that it starts working. But I think that value's a pretty good bet. So I'm glad that it sort of started working a little bit, but I don't know, like that could break down immediately. It could be a sign of exhaustion in the market or relative to the index. I really have no idea. That's not a very helpful explanation. That's
No, but it's the right, I mean, it's the right answer. Like there's so much other stuff that goes on in the market. And I'm sure there always was, but in terms of like options flows and, like I remember Bob Elliott, when this whole thing started, was talking about hedge fund positioning. There were tons of hedge funds short IWM who had to cover, and that was driving part of this. So it's just hard to know when you're sitting in it. Like, is this the lasting rally, or is this, there are a bunch of dynamics going on behind the scenes that is making this do this, and maybe it won't be lasting. It's just, at least for me, it's very hard to evaluate it like when we're sitting in it.
I always go back to, I think the way that I started investing is I read Buffett's letters when I was in university, and he talked about look-through earnings. And he said, what you're trying to do is grow your look-through earnings over time. So in portfolios that I run, so I run 2 ETFs, ZIG, which is a mid-cap, essentially, value portfolio, and DEEP, which is a small and micro value portfolio. In both of those, what I'm trying to do is grow the intrinsic value of those portfolios. And the way that you measure intrinsic value is, there are many different definitions of value investing. One is at that much more growthier end, where you say if you're buying it, if it's growing very rapidly and in 10 years' time it's going to be worth 5 times as much, then the price that you pay now will reflect that. You'll get the performance when it's up 5 times. And there are other ones where you say, well, it's at a discount to the sort of income and book value right now relative to the rest of the market, and that gap should close. They both work at different times of the cycle, and I don't think you want to be too stuck in one or the other, but I do think that the one that I prefer is the one where you're looking at the current discount, but you can't completely ignore growth. And so I think that my objective is to sort of maximize the rate of growth of that operating earnings, look-through earnings, so look-through earnings, for folks who haven't read those letters, is you basically look at the earnings of the individual portfolio names that you hold, and over time, the growth in those earnings should ultimately be reflected in the stock prices of the companies that you own. So you're not so concerned about the stock price performance, but you're more concerned with the fundamental performance of those names. And then the objective is not to overpay for that growth. So you have to be a little bit skeptical about very high rates of growth and paying too much for those, because growth just tends to attract competition, and as a result it slows down and it falls apart a little bit, and then you've overpaid. And that's one of the great sins in investing. So I try to be conservative in my estimates of what the companies will do, and then to buy at a big enough discount so that if it doesn't, even those conservative estimates don't work out, you're still going to do okay. That's why before I said, it's difficult for me to predict what my own portfolio is going to do, even at a business level. It's extremely difficult to predict what it's going to do relative to the index. And so I think if you look at what value has done over the last 10 or 15 years, it's not been a bad sort of absolute performance. It's just been a weaker relative performance. And that's one of the challenges with investing, is that you're benchmarked against an index. And really what you should be doing is concentrating more on what you're holding rather than that relative performance. But equally, it has to, over extended periods of time, it has to outperform that index. And I think the way that you do that is sort of the way that I've articulated. You find businesses that will grow, you try to buy them at a discount, skeptical about their prospects, and careful about the way that it's constructed, careful about risk. Too much debt is fatal, too much concentration at the portfolio level can be fatal, and all of those things sort of go into ultimately producing the portfolios at the end.
Do you think there's anything to this idea that as fundamental investors, we have to lengthen our time frames? So the idea is that whatever that fundamental value is, you've got what the market's recognizing. Do you think there's something to whatever's going on in the market that's not converging as much as it used to, so we have to be more patient than we did in the past?
That's a good question. It's not really one I've thought about a lot. I don't know that, I don't think that anything necessarily changes. I don't think much changes on a secular basis, because I think ultimately the reason for the outperformance is behavioral. The argument is always, well, there's so much more information. Screening is so much easier. So nets used to be, you think about the process of finding a net when Benjamin Graham was doing it. You had to ask right away for the annual report, which was sent to you, and then you mechanically calculated that, and then you bought these companies at big discounts to the liquidation value. And now screening is a trivial exercise. You can find free screeners online that will show you all of these names, and you can put those in. And yet, it's been a while since I've done this exercise, but there was an Oppenheimer paper, and he looked at the returns over some period of time that sort of escapes me a little bit, but I think it was about 25 years to 1983. And then I replicated that paper. It was 25 years to 2010, taking the period that he hadn't looked at, and found roughly the same outperformance, even though screening had become materially better over that period of time, which makes me think that the real reason for values outperformance is behavioral. People are trying to buy companies that have gone up a lot. Like most people who aren't stock market people, when you talk to them, what they're hunting for is something that's gone up a lot. They've got a tip, and it's something, the reason that they like it is because it's done, it's like Tesla, it's gone up a lot. It's Nvidia, it's gone up a lot. They buy it because they think it's going to go up a lot more. Whereas what stock market people are doing, you and I, probably other investors, are trying to find things that are at a discount, are reasonable prospects. And so when we're doing that, the way that you find things that have reasonable forward returns is typically in something that's a little bit depressed right now. And the reason it's depressed is because it just doesn't have a lot of attention, or something's happened to it. And you have to be able to sort of ignore that immediate news. But that idea is not a new idea. Like that idea comes from a Lakonishich, Schleifer, and Vishny paper, which came out in 1994 about behavioral economics. And they said there are two types of investors. There are these naive extrapolation investors, which was the first kind I just described. They look at stock price has gone up, stock price is going to keep on going up, stock price has gone down, stock price is going to keep on going down. Or maybe another level of sophistication might be earnings have gone up, earnings are going to keep on going up, earnings have gone down, earnings are going to keep on going down. And then on the other side, there are mean reversion investors who say, well, everything exists in a business cycle. Most things cycle. Not every company cycles, but most companies cycle. At the top, they look great. They've had years of earnings going up. They're expensive, and they've got two things working against them. It's expensive share price, and probably they're at the top of their cycle. But they look great. They're easy to buy. On the other side, there are companies whose earnings have been going down and their stock price is depressed as a result. So they've got two things going for them, which is that they're more likely to mean revert on a business level, and at the same time, that big discount to the stock price is probably likely to close. And so it doesn't feel very comfortable buying them. It's a behavioral effort to buy them. You kind of have to, everybody knows what's wrong with this thing. I'm buying it, so I'm going to look like an idiot when I buy it. But I know based on the historical performance of these types of companies that they're more likely to turn around, more likely to see that discount close. And so they do better. And it does seem to be that is actually what happens. People who buy these high growth companies, they do tend to deliver pretty high growth, but not as high growth as they had expected when they put the positions on. And as a result, the stock price doesn't perform as well as the earnings, and the earnings don't perform as well as they were expected to. And the converse is also true, that the value stocks, they do seem to disappoint on an earnings basis a little bit, but they do a little bit better than they were expected to. And the stock price does better too. And so that's the reason value tends to outperform. It's behavioral rather than sort of an informational advantage. I really don't think there's much of an informational advantage anymore, if there ever was one. I think that it's almost exclusively behavioral, but I think that that's an enduring advantage.
You had an interesting chart you put on Twitter that we'll put in the podcast, and it was getting at some of these points you've been making in terms of, we've got the S&P 500, the S&P 400, and the S&P 600, and you can see here how much of the 5-year return is multiple expansion versus actual growth of fundamentals. And you can see on the small side, basically all of it is growth of fundamentals, and on the large side, a huge portion of it is multiple expansion. So you wouldn't expect that to be sustainable for the long term.
Well, I think that that's a little bit counter to I think that's a little bit counter to the ordinary expectation in the market. ordinarily, it's the other way around, that you get the multiple expansion in value and you don't get the multiple expansion in growth. It's the other way around. You get multiple compression in growth and multiple expansion in value. Through the very worst performance of value, I don't know when it was exactly, but say probably starting from 2010, it sort of started underperforming, but it was getting dire. It was ugly by like 2018, 19, and really March 2020 was brutal for value. It was wide underperformance. And then didn't recover as well out of that bounce. Do you remember that? It's sort of the rest of the market. That was my expectation was, well, we've had a crash. Typically value works well out of the beginning of the renewed cycle. Value should bounce really hard and we're back. And it didn't happen at all. All of that bounce was in the bigger companies and value kind of missed it a little bit. And so that last 5 years, I think has defied my expectations at least, and based on, looking at all of the data that pre-existed. It's not the data goes back to 1963 point in time. And then we've got sketchier data going back to 1926, and then sketchier data still going back to 1875. And then like fragments of like data that goes back to 1825. All through that period, there's a clear trend towards value outperforming, and the value outperformance over the whole period is massive. But there are these 6 periods of time where growth massively outperforms value for sort of extended periods of time, 5 to 10 years. The most recent one was the longest period of growth outperformance. Every single one of them has centered around a stock market boom, often associated with some sort of new technology. So the 1825 one was steamships. And there have been, telegraph, the introduction of the telegraph, which was like a information technology of its day, and so on. Everyone's been associated with like an electronics boom in the 60s, the first .com in the late 1990s, and then this most recent .com 2.0 or the social revolution or whatever, the social media revolution, whatever we want to call this one. Ordinarily, it's multiple expansion for value, multiple contraction for growth. I think I've got a podcast and a public Twitter account. And one of the criticisms that I saw and I was sensitive to through that very long period of underperformance was, well, if you're a value investor and you say you care about the fundamentals of these companies, isn't it a little bit hypocritical to be looking for multiple expansion? Isn't that what the growth guys do? Like they're looking for the multiple expansion. And here you are saying you're relying on multiple expansion when there's going to be some fundamental deterioration. And I thought that was actually a pretty good criticism, even though that's really the way that value works. It is to find that multiple expansion. But I did think that's probably a valid criticism. And so I retooled my own investment process a little bit to make sure that whatever happens. So I do essentially 2 valuations. One is to make sure that it's cheap on what we're currently seeing, but also will you generate sufficiently good performance from these names if you have no multiple expansion over the holding period? If you just get the fundamental performance, will it be sufficient to justify putting these positions on? And so I think that was one of the material changes that I made to my process through that 18, 19, 20 period of value underperformance. I haven't really seen much of a return to value, I don't think yet. I think it's it's worked in fits and starts, but it's still very clearly a growthy, large cap market. And I don't really know why, because I think that the reasons for value, one of the reasons that I thought was a pretty valid one, was that interest rates were set to 0, cost of capital is nil. Marginal project, when your cost of capital is nil, like it's any project looks good. Value has always been a little bit more risk averse. You're looking at the downside. And so many of those projects, that risk aversion just didn't count for anything. It didn't matter when the interest rates are set to 0. But here we are in a world where interest rates are much, much closer to the long run mean of around 6%. I think we're at I think we're around 5 or 6. I think we're getting close to the sort of the long run mean here, maybe just a little bit underneath it. And yet it's still, real estate market has performed very, very well. The top end of the stock market has performed very, very well. All sort of assets have mooned, even though rates are up. So I don't really know what drives it now. But I still think that it's a mean reversion, multiple expansion market, and I don't really know what turns it around other than just something ephemeral like market sentiment changes, and maybe that's what we're seeing now. Just people get nervous about the fact that Nvidia is so overextended, or Tesla's. Google had a bad, not a bad print, but a less sort of exciting print recently. Tesla had a funny earnings print. It looks like they haven't sold as many cars. Maybe there's just like a little bit of people getting a little bit tired of those stories. It's not as exciting as it used to be. And you look at the Russell 2000, some of those smaller indexes, maybe they look more interesting. I don't really know. I think it's sentiment or fashion, and those things are incredibly hard to predict.
Yeah, it's interesting because we talked to you on a previous podcast about David Einhorn's idea that, fundamental investing doesn't work anymore. And you disagreed with him. But it's interesting, like at the end, you kind of have a similar conclusion in that both of you are really focusing on companies where you don't need multiple expansion. That was his conclusion, and that was kind of your conclusion as well. And what's interesting about it is if you look back, if you look at Fama and French's migration paper, to your point you just said, like multiple expansion has been a big part of at least the value factor's return over time. So, I mean, maybe we're in a world where that's going to be less of the return going forward. I mean, I don't know, but like that migration from value to those other more expensive groupings has been a big part of value's return historically.
And for the smalls as well, it was always companies would come on in the Russell 2000, and the ones that did very well would migrate up to the mids and then the S&P 500. And I don't know whether it's just the professionalization, the institutionalization of venture capital, or it's something like the listing rules are so much tougher with Sarbanes-Oxley. Like Sarbanes-Oxley introduced a huge burden into listed companies of like $1 million a year, which for a big company is trivial, but for a little company, that could be, a very large proportion of their profits. If a company's making $5 million, $1 million is 20% of its profits, which, on a multiple, like that's a very material part of its market capitalization. And so where previously these companies would float when they were small and grow through it, they thought, let's stay private. VC's there to support us all the way up until we're massive companies. The VC valuations to me are just astonishing. I see these companies I've never heard of before. I saw one today. I've never heard of it before. It's got a $10 billion valuation and it's, zero revenue. And they've raised billions of dollars at that level because there's some AI related play, which, it's a new name that I've never heard of before. Most people won't know. I'm not even going to say this name, but there's clearly so much VC out there that there's no need to tap public markets and expose what you're doing, expose yourself to the risk of Sarbanes-Oxley and the increased reporting obligations. You can just stay private and you're only dealing with the VCs. And then you get your big exit subsequently, like Facebook, which exited at a huge valuation. It was a huge company by the time it exited, and that's been the trend for a lot of these companies. So I think that mechanism has gone away a little bit, and it's a shame because it still exists in Australia. You can list Australia on the main board. In the UK, they have the AIM, which is a secondary board for companies that are a little bit earlier stage. And in Canada, they have the TSX Venture. So companies can come on at smaller, less developed stages, and then smaller shareholders can participate in that growth. So taking that away, maybe that's a reason for small not performing as well and value not performing as well. The only thing that I would argue against that, though, is that there's it's a paper that I refer to quite regularly, and it was called the Darwin's Darlings, or Extinct Species, something like that. It came out in 1999, so it was pre-Sarbanes-Oxley. And the authors were writing about exactly the same idea. There are all these companies, they're small, they're doing very well. They're family controlled, growing earnings very rapidly. doing very well, like establishing themselves as businesses, but they can't get into the indexes. Like they can't even get into the Russell 2000. So they just can't get a bid. And even in the Russell 2000, there's so little capital flowing into it relative to the bigger names that they can't. And so they're completely broken down. They've got to come up with some new way of getting out of it. And I think that was what created the activist boom in the early 2000s and the private equity boom in the early 2000s, where these really were good businesses and they went private and the management teams benefited. But they sort of, unfortunately, the index has missed out on that performance a little bit too. So it's hard to know. I just, on the Einhorn thing, I just say his solution to it was that he was going to find companies that were turning their real free cash flows, their excess free cash flows, into buybacks and capital returns. And the only thing that I think that my point of distinction was, there are two sources of return always. There's the reinvestment in the business. And even if you're not getting multiple expansion, you should still be getting business growth. And you should be largely agnostic to where what you're trying to do is just buy something cheap on a cash flow basis. And then what management does with it, ideally they take advantage of the undervaluation, but it's not a sin if they don't. They're allowed to reinvest in the business and grow the business too. And ultimately, maybe they grow the business big enough that you do ultimately see that multiple expansion. So I'm just agnostic to it. I buy things that my preference is that they have free cash flow. My preference is probably that where they have that opportunity, they buy back their stock. But in terms of capital allocation, there's a list of things that they can do. Buybacks are on that list, but they're not the first thing. The first thing would still be reinvesting in the business if they're getting a reasonable return or their forward returns are reasonable.
You alluded to how you pick businesses to invest in, and that's what I want to spend the second half talking about, because you've been doing this in the real world for a long time. And I want to walk through your process, from the beginning to the end, and maybe talk about how you think about building a portfolio of value stocks. So let's start at the highest level. So in terms of a universe, and I know you run two different funds, and I think one is smaller cap than the other one, but how do you think about like setting your investable universe and the stocks you can pick to invest in?
So there are two, it's the same identical engine picking stocks in both. It's just they're separated into two universes, and that's literally one single line of code that is changed in the two, and otherwise they're identical. And that line of code just says, for my mid cap, so I have one that can buy mid cap and above, but it tends to be concentrated to the smaller end of mid cap currently, although that hasn't always been the case. When I first started running it in 2019, it tended to buy, I thought large cap value was more undervalued then, and it was concentrated more in large cap value. As I've run it, it's one of the things that I've commented on before. The market capitalization has gone down very materially. And you can see, if you go to the Morningstar style box, and you can see the historical, it used to be large cap value, and now I think they call it mid, or it might even be small cap value. And that's ZIG, which in my mind, it's a mid cap value fund. And the way that we screen there is the largest 25% of names, but it's sort of much more concentrated towards the lower end now, because I think that's where the opportunities are, not because and that's not like a policy decision of mine. That's just the outcome of the process. I don't have any influence I'm not directing it there. It's just that's where I'm finding the cheapest names right now. And that's also true in the small and micro. So the small and micro is the smallest 75% of the stock market, which is actually a vanishingly small. It's a very large number, but it's a vanishingly small market capitalization. They're very small companies in there. And you'll see it in the Morningstar style box. It hangs it's below the small cap. It really is small and micro. And so it's the same process in both, but it tends to be at the very small end. And it's not always going to be that way. I'm trying to go where the opportunities are. And then in there, my preferred metric I call the acquirer's multiple, which is basically the way private equity firms and activists think about these companies, because what we're trying to do is maximize the operating income that we're buying per unit of our what we're actually spending. And so market capitalization is one measure. And so if you think about a price earnings multiple, that's market capitalization to the bottom line profit. What the acquirer's multiple is enterprise value to EBIT operating income. So that's enterprise value is market capitalization, but it also looks at the debt that the company has, any cash that it has offsetting the debt, any preferred stock, which is a real cost, minority interests and other things like that. So it's just a more full examination of the price that you're actually paying. And on the other side, you're looking at the operating income on an accounting basis that it's generating. And then I do some other checks and balances to make sure that that operating income is actually a cash flow. They don't match up year to year. Any given year, there might be a divergence between the accounting measure of cash flow, which is operating income, and the actual cash flow that comes into the business. But that's because cash flow statements are a reconstruction from the income statement. And it looks like changes in cash at bank and various other things. Over time, they should match up, but in any given year, they don't. And I just find that the operating income is the first measure of cash flow as a reconstruction. And so I use those metrics to work out, we're trying to maximize the operating income that we hold and the operating income that we'll have in the future. And so the way that I think about that, the second step is to make sure that money that's reinvested in the business will return a greater return than it would be being returned to me. So I want reinvested money to earn more than $1 of market capitalization value, which means that it has to be earning at a higher rate than I can get myself. So that's a complicated way of saying that the S&P 500, the return on equity for the S&P 500 is about 13%, which is quite high, I think. You look at the rate you get for cash is 5. So money reinvested by the S&P 500 returning 13, that's a pretty good return. A lot of that is achieved through leverage. So that's not a real return on assets. So I think about it, X the leverage, take out the leverage, look at the return on assets in the future. So not the historical number. We're sort of making an educated guess about what the future is going to look like. Will money reinvested generate more than what the market requires for this reinvestment? So if you're reinvesting and you're getting less than 5%, you really want that money paid out. If you're getting more than 13%, then you want that money retained by the business. And in between, there's a little bit of a decision to be made to, over time, you want the operating income to grow, and you can turn that into a perpetuity. You're just looking at what the business, the normalized full business cycle expectation for the return on what is reinvested in the business, what it will return, how the market will treat those earnings returned, and then you can add on to that any payout that you get, so any buyback, any dividend, any return of capital, and Meb Faber would call that the shareholder yield. So I can call it the shareholder yield plus the reinvestment, the rate of return on the reinvestment. Those two things together, you want to maximize that across the portfolio, and so that's what I'm trying to do. The way that you achieve that is by paying very modest prices, being skeptical about growth, and being patient, sort of giving these businesses enough time to kind of work their way through. But it means that my portfolio, it's a deep value portfolio. The skepticism, I think, makes it a deep value portfolio. I just tend not to pay up for growth, but I am prepared to pay more for better businesses, and I think that that's what but not too much more. So it's very much a deep value, small portfolio, but I think within that, we do pay up a little bit for businesses. And I think that was one of the changes that I've made since I ran the portfolio. I thought that initially it was just pure multiple or pure price multiple would generate the returns. And now I think you can pay up a little bit for some better businesses. And that's what I've tried to do across the portfolio.
Yeah, it's similar to what Buffett's done over his career. Starting in the deep value space, but then realizing, maybe bringing a little bit of quality to this is a better proposition.
Yeah, I'm a shameless fan, cloner of Buffett's methodology. I've said this to many people. I've been reading Buffett since I was about 17 years old, and I've reread those letters probably every 5 years since. And it's amazing the number of times that I think that I've come up with an original idea, and I go back and I read about Buffett writing about it in about 1983 and then dismissing it and explaining why it's a bad idea. And I have thought that it was an original idea and a good one. And I read his sort of dismissal of it and then kind of understand a little bit better. But the first time I read it, I didn't even understand the implications of what he was saying. I just read through it and went, oh, yeah, I get that, and clearly didn't. So I'm yet to sort of get outside of his thinking. I'm still working on that.
It's interesting. I also think there's a behavioral reason, going back to what we talked about before, for adding the quality to it, because those companies tend to be a little bit better companies. They're a little less volatile. And one of the things I've learned over my career is you've got to focus on the end investor that's actually using the strategy. And that end investor, if you're at the bottom of the barrel value stuff that's very volatile, they look at the names in their portfolio and they're like, why do I own this garbage? Like, it's very hard for them to stick with that. And it's probably a little bit easier when you move a little bit more towards quality and you get a little bit better companies.
Well, that's the reason that I wrote the book Deep Value, because I'd have these conversations with people and I'd say, why do we own this? This is crazy. Like, look at this stuff that you've got in this portfolio. And there's a good reason for owning this stuff. It is going to mean revert, or there's a good chance of mean reversion here. Across the portfolio, that's my expectation. And so I used to do that and give that explanation. People would say that's not the case, but that's also true that there is a great deal of volatility, and you hope that you're on the good side of the volatility, but it does cut both ways. Those little companies, when there's some concern about them, and then they stumble, and it takes a long time for management teams to fix problems. And when they don't deliver and that the mood is dire already, then they get cut to pieces when they stumble. And so it is a concern. But I also think there's a business model element to that, and a capitalization, like too much debt with a funky business model. When they don't deliver, they get cut to pieces, probably rightfully so. You want to have a bias for better business models. But having said that, everything at a price, you can overpay for good business models, even though it doesn't. I think that's the lesson that everybody has learned. It's the wrong lesson, is that you can't overpay for some of these business, because there's, the compounder style businesses that just grow over time. Like, yeah, you make a mistake, but just hold on for 10 years and you'll be okay. But I think what 2022 showed us is that, you could be down 90%, which is as good as, bankruptcy for some of these names. Like if you're down 90%, you got a 10 bag just to get back to break even, and that's hard to do. So I think, even though it's not a very popular kind of idea at the moment, I still think that sort of conservatism in valuation and skepticism about growth keep you alive. Like perhaps the big difference between me and many other of the growthier compounder type investors is that my objective is not to generate the highest returns that I can possibly return. My objective is to survive first and foremost. And so that cuts out a lot of a lot of the universe becomes uninvestable for that reason. There's either a problem with the balance sheet, there's a problem with the business model. It's just unproven. It's too early to say whether it's something that I just can't get enough of an idea about what it looks like through a business cycle to make a decision one way or the other. And so I think that makes it uninvestable, and you probably miss out on returns doing that. You need to, I watched a lot of these guys who are the more compounder type investors, and they would say, well, you need to buy these companies when they're losing money, because they're going to inflect when they become cash flow positive and ultimately profitable, and you miss out on all of that return. And that's true. It does seem that you miss out on all of that return, but sometimes you also, they don't quite get there and they fall apart. And so there's risk in that untried business model. And so I'm just more of a conservative, skeptical investor. And it's not just personality. It's because it's based on data. Like, I've done a lot of back testing. I've looked at a lot of research. The reason that I invest is because of those reasons. I've looked at the research, and I think that it's the best way to do it over the long term, even though short periods like this where you underperform are painful. It's not a new thing. Like, that's gone on, as I said earlier, where there have been lots of these periods, and they go on for an extended period of time. And I understand that people can say, well, 10 or 15 years, like that's like half of an investment career or something like that. Like, that's a crazy long period of time to be buying value. But it's not like this, and this is the longest period of sort of underperformance. But they're not, it's not the first time it's happened. There have been very long periods of underperformance, and they've all resolved ultimately to the price matches the underlying performance of the business. And so that's where your attention should go, to the underlying performance of the business rather than the price action.
Yeah, Matt Favors talked about this a lot. This idea that he's talked about, like, when you're running a strategy like value as an investor, when you're investing in a strategy like value, you really have to think, in decades in terms of your time frame. And so many people are out there, what's your 3-year performance? What's your 5-year performance? Even, what's your 1-year performance? And that's just not the way these kind of strategies work. Sometimes you get lucky, you invest and you're at the perfect right time and you get great returns and it's 2000. But other times you invest and it's, you see the other side of that.
It's totally understandable. Like, I can completely understand. Imagine investing for 5 years and underperforming and saying, yeah, I still know what I'm doing. It is possible though. And that's just the nature of the markets, that there's so much randomness and the trends can go on for much longer than anybody expects. I think that, there are quantitative strategies, there are quantitative momentum strategies that work very, very well and over long periods of time. But I think that they're looking at, when I say shorter term trends, like momentum might look at a 1 year, anything from much, much shorter periods, 3 months through to 1 year. And values, I think, more like a 3 to 5 year type time period. So trend certainly works in the shorter term, and I think fundamentals work in the longer term. But having said that, I think it's very hard to predict where even a business will be fundamentally in 5 years' time. I think that that's the absolute outer limit. And I think that that's sort of borne out by the research a little bit too. When you look at you can't predict out beyond 5 years. And then the price action certainly is not predictive beyond 5 years. So you would expect that if you're going to generate excess returns from value, you do expect them in the first year or so. And then it becomes a sort of market return beyond 5 years. And there's this asymptotic line from excess return to market return over those 5 years in the ordinary course. So, when even value guys, when they're saying, I'm going to build these complicated models that go out and predict out into the future, it's not backed up by the data.
How do you think about the number of stocks in your portfolio? This is something I've struggled with a lot in my career. Like, I like running concentrated portfolios, but I also, have tended maybe early in my career, maybe to a little too much concentration. Like, how do you think about getting that optimum number of stocks to hold?
Yeah, I was too concentrated early on too. And that's Buffett's fault. I'd read, Buffett's letters, put your best ideas, most amount of money in your best idea, and use the Kelly criterion to weight, it's edge over odds. So your best idea should have the most money in it. The most undervalued idea should have the most money in it. I think that that's the right approach if you're trying to maximize your rate of return. But I think that it introduces enormous volatility and path dependency and just idiosyncratic risk into your portfolio that's unnecessary. I wrote a book called Concentrated Investing, where I looked at those two ideas, concentration versus diversification. Looked at value guys who'd outperformed for extended periods of time, like 25 years. And then looked at the academic approach to concentration and diversification, and also the practitioner approach from everybody from Graham on one side to sort of probably Munger and Buffett on the other side, where they're much more concentrated. The decision that I made ultimately was that there's something that the academics probably have it right. But the academics are trying for. The academic approach to diversification concentration is to replicate a market portfolio with the fewest stocks possible, because when they were doing it was expensive and difficult to build out a portfolio of stocks, because they didn't, now you trade virtually free with a Robinhood account. But back then you had to pay pretty hefty fees to get these names into the portfolio. And so they said, if you just randomly pick stocks, it's actually hard to deviate from the market performance. Because if you're randomly picking, you're going to get some winners, you're going to get some losers. We want to replicate the market portfolio. So that's systemic risk. So how do we get that market portfolio? And they found that 30 names, somewhere between, I think 20 gave you 90% of the market return, 30 gave you 95% of the market return, and then beyond that, you were sort of spending more money than you needed to. That's not my objective. My objective, and the objective of Graham and other investors like that, is to outperform the market. And so you have to introduce some sort of tilt into your portfolio, and value is an obvious tilt that works. Quality is an obvious tilt that works, and size is a sort of side effect of probably those two that you can introduce into the portfolio to outperform. So then the question is, how much money can you lose? Can you afford to lose in any idiosyncratic pick? Because clearly, there are no free lunches in the market. The reason that you're getting something that seems like value at a surface level is because there's some underlying problem with the business. And in many instances, the market is right, and these things deserve to have their discount to what they look like on an earnings basis. And I've found it's about 50-50. Half the time, the market is over the holding periods, over my quarterly holding period, which is a short period of time, but it's replicated over and over and over again. So it is like a long-term window. Over a quarter, it's a 50-50 proposition whether a business outperforms or underperforms. So in my portfolio, what number of names do I have to hold so that I can capture the upside performance and not suffer too much on the downside performance? And I've found 30 is about the right number on the low side. And so Zig has 30 names that equal weight. At the beginning of every quarter, for my own internal purposes, I write down whether I think one will outperform or underperform the index or be up or down. And I'm on like 50-50 on picking which ones are going to outperform and underperform. So it's like a coin flip. With my small and micro portfolio, I have 100 names. The reason is that the businesses are a little bit less good as measured by their returns on invested capital and their sort of prospects for growth and so on. They just tend to be managed by less experienced managers. And there's some argument that if they really were better businesses, they would have grown out of that where they are. And so it makes more sense to have less exposure to each name. But then in addition to sort of just the idiosyncratic exposure to names, you have to think about things like, how much exposure do I want to an industry? And so the problem is going to be, often industries get cheap, or every name in an industry gets cheap at the same time. So there's a problem, oil, something that's driven by the oil price. If the oil price goes down, all of the majors and all of the explorers and all of the miners are all going to be down along with it. How much exposure do you want to that industry or that sector? And that's a more difficult thing to answer, because if you are only interested in performance, you want to maximize your exposure to that industry. But if you're also concerned about survival, then you want to minimize your exposure to industries that don't recover. And there have been lots of examples of that in the time that I've been active in the market. So one would be for-profit education. Those for-profit education businesses were all phenomenal businesses that had very high returns on invested capital, very asset light. A lot of the money got paid out and the stock prices performed very well for very long periods of time. And then the administration decided that they didn't like the business practices of those businesses. And so they changed the way that they were remunerated. And they all got cheap, or ostensibly cheap, based on the historical earnings. And so you could easily have filled a portfolio with for-profit education names, and you ultimately would have been zeroed out because every single one of them essentially was taken out or bankrupted down, 90%. So that's always in my mind as a possibility that something's not going to recover. So if an industry is not going to recover, how much capital do you want exposed to it? Just through trial and error, I think it's about 20%. So I tend to have some exposure through testing. I think it's about 20%. So I'll have exposure to an industry. Most industries are going to recover because it's purely cyclical, but not in every single case. And so I'm mindful of that. Ultimately, we want to survive more than we want to generate excess returns, or survival is a precondition to generating excess returns. So it has to be survival first. So those are the sort of things that I think about in diversification concentration. I think that concentration is, one way of testing concentration is you just say, well, what if I just run a 1-stock portfolio? What if I run a 5-stock or a 3-stock portfolio or a 5-stock portfolio? 10, 15, 20, 30, 50, 100. And then I can test the performance of all of these portfolios and then just compare them. At what point do you generate sufficiently good returns with sufficiently mild volatility that the combination of return and volatility gives you, that's alpha, or gives you good performance. And so I've just found that it falls out. It's somewhere between 30 and 100. You can get better performance at 20, but you introduce more volatility. Get very good performance at 5, but you have massive volatility. And at 1, you run the risk that you crash into something that goes to 0, even though over a long period of time, the returns look very, very good. In the future, one of them could be a donut. So 1 is probably too concentrated. 5 is probably too concentrated. But for investors at home, I think 10 is probably okay. You can probably manage to 10. Because I manage money for other people, I think the number's more like 30 to 100. And I think that that's the best combination of return and volatility, idiosyncratic exposure to names and to industries and so on. So I think that's why I run the portfolio the way I do.
Yeah, on the sector concentration thing, I agree with you. And I've kind of come down on the same way. We had Wes on the podcast, and he was talking about this. And he was saying, first of all, you have to distinguish long-short value from long-only value. You and I both use long-only value. Long-short value, you pretty much have to do sector neutral, because if both sides are going against you, that's going to blow you up. But like on the long-only side, a bunch of the return comes from overweighting these sectors. So it's about finding that balance. You don't want to own 90% financials in 2007 or something. So you have to have some sort of limits. But if you just say we're going to run a sector neutral, you're probably taking away a bunch of your return doing it that way.
Right. Yeah, that's exactly right. And Wes and I tested that. We wrote quantitative value, and I think that I'm using it. This is not the way that Cliff Asness intended it, but sin a little, I think, is the right idea. That if sector neutral is not sinning, then sinning a little is like leaning a little bit more into a sector than you would otherwise do. But I do think that in order to generate some return, some excess return, you really do need a little bit more exposure. So far for me, that has worked out. You do want a little bit more exposure to oil. When oil goes to 0, you want a little bit more, expecting that it'll recover and the names will recover too. You want a little bit more exposure to names that have been beaten up. They do tend to be in industries that they've all gotten beaten up together. So you want to pick the best handful of names out of that industry and have a little bit more exposure to it. But always knowing that there's a risk that, so coal is a good example. The coal names I thought all got very cheap a few years ago. But coal has, there are political reasons why coal may not recover. And coal there are no new coal mines being built. Some of the arguments against investing in the sector, but there are arguments for investing in the sector. So there are no new coal mines being built. So that means they're probably going to be supply constrained. But equally, they might be putting some of these coal companies out of business. But then my argument, the argument on the other side too, is that if we're going to be investing in green infrastructure, it requires steel, it requires coal. So coal's not going anywhere. So that was the argument there. But I was nervous about it when I saw those names come into the screen and into the portfolio ultimately, because it wasn't clear which way that was going to go. There's some political pushback against coal and oil and a few of those other things, even though I think they're ultimately too important to the economy to sort of rip them out. But you never know.
Yeah, and I think also, like, people always concentrate on the overweight part of sectors with value, but the underweight part's really important too. Like, I don't want to be, if I'm running a sector neutral portfolio, I don't want to be forced to own tons of tech in 1999, and find whatever's the cheapest, even though it's not really cheap. So both of those things, I think, work in favor of value.
Well, that's a great point. And I think that that's probably one of the reasons that value suffered through this period, was that probably we were all underweight tech, because tech was optically expensive, but continued to get much more expensive than any of us sort of anticipated. But equally, like, the underlying, the businesses were growing so rapidly, they were sort of defying base rates. These companies like Amazon and Google and Microsoft, we've really got nothing like them in the backwards looking data, where they're that big and continuing to grow at such high rates. I had a look at when Buffett sold out of the airlines. I went and had a look at the size of the airlines, because I held some at that point. I don't have any sort of discretion over whether they get included or not. They were just cheap. I held some. We did ultimately sell out of them, but like not for discretionary reasons. It's just that they didn't perform very well, and then they were expensive relative to what they look like. But they were all, $30 billion, $50 billion market capitalizations. And then you have Google, which was close to $2 trillion. And Google was earning that kind of money on a quarterly basis. Like Google could have bought an airline every quarter through that period of time. Like the scale was so vastly different for those businesses. And it was shocking to me that they were so much bigger. I hadn't kind of quite appreciated how much bigger they were than most other parts of the economy. And if you look at, so Michael Mauboussin produces those base rate, those guides to base rates, and there's just nothing like that scale, that size of businesses that have continued to grow at the rate that they had, like 100% growth of Amazon when it was one of the biggest companies in the world, kind of in a year, kind of extraordinary rates of growth. And there was nothing to suggest historically that was possible. I wouldn't necessarily make a decision one way or the other. I'm not considering those base rates when I'm constructing the portfolio, but it's just sort of, Meb Faber will produce those charts every now and again where he shows like this is the performance of the biggest name in the market after it becomes the biggest name in the market. And it's almost always very bad performance, historically over the years that follow. But that's not been true more recently, that those big names have had huge momentum, and it's not just stock price momentum, it's business momentum as well. They've continued to grow, and it doesn't seem to be any limit to how big they can grow. They're now, half of those names are bigger than stock markets around the world. They're certainly bigger than the Russell, the entirety of the Russell 2000. They're vastly huge companies. The index is like heavily weighted towards them, but it's not like when the index was heavily weighted towards Exxon. At one point, I think Exxon was 40% of the index. Like, do you want 40% of your portfolio in an oil and in a commodity? Probably not. But do you want 40% in Microsoft, which has got recurring income, or Amazon, which is largely recurring income? I mean, probably. Like, those are still very good businesses. It's not as much risk having that exposure to them as there is to having exposure to Exxon. So there are some questions that we value guys, fundamental guys, probably have to resolve a little bit. And I don't know how to do it, but it's the market certainly has changed in that respect. That's one big difference, that we can run these huge businesses at scale. Where previously that was more difficult.
It's something I think about all the time, because if you go back and people will have those charts of like the top 10 companies in the S&P 500 going all the way back. And as you go from decade to decade, they're almost always different. And I wonder about that. Like, I wonder with these companies, is there something different about these businesses where maybe in a decade, they're still going to be the largest companies in the S&P 500? Maybe with the technology and the advantages to scale, something's changed. I don't know the answer to it. I don't know if anybody does, but it's an interesting thing to think about.
Yeah, I couldn't agree more. I think partially it's because they've got one product that everybody uses. And we're also locked in. I mean, it would be very hard for me to use something other than Word or Excel, even though I do use the Google alternatives, but that's not really, one or the other. They're still the biggest names in the market. I'm stuck in Gmail. I'm never getting out of Gmail. I find it hard to believe that Amazon's just so easy to use. I don't even check the prices to see if they're the cheapest. And I think my wife tells me they're not. They're always more expensive. So I should be checking something else. But what's the alternative? It's like Walmart is the alternative. So there are very few choices for the convenience or the lock-in. I could easily imagine that in 10 years' time, it's still mostly the same names. Unless it's something like, NVIDIA was a little bit of a dark horse. It's for me anyway, it's largely come out of nowhere and then grown at extraordinary rates, particularly considering the size that it's at already. I think that it's probably got a little bit ahead of itself, but the business itself is still incredibly impressive. But it's hard to know again, because it's those other big companies that are consuming NVIDIA's chips. Will they continue to buy at that rate? That's one thing that Jake Taylor, who's my co-host on the podcast that I have, pointed out, is that the capital intensity of these big businesses, where historically they've been like not particularly capital intensive, they are becoming increasingly capital intensive. And Facebook was one that I was looking at which companies reinvest just in absolute terms beyond their maintenance capex, and I was just using his, if you just say depreciation and amortization is maintenance capex, and then any reinvestment above that is growth capex, that's not accurate, but it's just as a sort of shorthand, rough way of figuring it out. What are the biggest investors in the market? And the two were Tesla and Facebook. I was kind of shocked by Facebook, and that was probably when Facebook was spending most of its money on the metaverse, but it was still kind of shocking to me that it was, I would think of Facebook as being it's a couple of websites, it's a couple of apps, but really the infrastructure is enormous, and that's true for Google and for Microsoft as they build out the cloud and they build all that back end out. It's going to be hard for them to get the same rates of return on those investments that they've had, but equally, it's going to be impossible for anybody else to compete with them because no one can spend that kind of money. But they're going to be less good businesses in the future, and so they may not have the same premiums, returns on invested capital that they've had. They'll still be very good businesses. They just won't be as good. They'll be vastly bigger, but the business will be bigger and they won't be trading at such a huge multiple.
Well, Toby, as is always the case, we have so much interesting stuff to talk about when you come on that we don't get through about half of it in an hour, but we'll have to have you back at some point. You can maybe take down Cullen's record, and we can also, you can take the sole lead, and we can also go through the rest of it.
Yeah, that was fun. That was really great. I love chatting to you, Jack. It's always good. I think we think very similarly, so it's a good chat.
Where can people go if they want to find out more about you or about your funds?
Acquirersfunds.com or acquirersfund.com. I'm on Twitter at Greenbacked. It's a funny spelling, Greenbackd, or you can search my name on Amazon. Tobias, Carlisle, you find all my books. And acquirersmultiple.com, we got a free screener. It shows the names that we're talking about. What I think are the cheaper, bigger names in the market. And the two funds are Zig and Deep.
Thank you, Toby.
Thanks, Jack. Pleasure as always.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.